Simply how much home could I afford is what you're wondering. I'll give you the formula in this video to figure that number out. But first, there are a few things you should understand. I'm certain that you're aware that homes today cost astronomical amounts, with the median home price across the United States hovering at $375,000, up 10% from the same time last year, an increase that a few years ago no one could have imagined. Daunting, certainly. However, if you're thinking about buying a home right now, the most important part of buying a home is this: what can I afford? The answer to this question is all the more crucial in today's red-hot, warp-speed housing market. Knowing your financial numbers and understanding how much of a home you can afford will give you a little more advantage once you hit the housing market. If all you've got is a hazy concept of what you can spend, selling agents will have a difficult time taking your offers into consideration. Even worse, you likely will find yourself and your family in a bidding war on a house and you win, only to realize later that you've gotten into a loan amount that is beyond your means. The answer to becoming a homeowner today would be to possess a bull's-eye focus on what's financially with you and your family's reach, and promise not to spend or invest a nickel more. You'll want to head into a home search with your financial figures at hand, understanding perfectly what your top number will be. If you really can afford a $250,000 home, don't look at a $300,000 homes. When you look at homes that are higher than your top number, you're naturally going to like the higher priced homes and start rationalizing why it makes sense to spend more. Know your top number before beginning the home search with your local real estate agent. Of course, this top number can be significantly different for each family. And while figuring your top number out may seem daunting, it actually comes down to just a few simple principles. Here's what you'll need to know to get a handle on your home buying spending plan in order to find the home that's priced just right for you and your family's needs. First question to get answered is, what is the largest amount you can afford on a home loan? Many homeowners make sizable down payments on the purchase of a new residence, typically 3.5% all the way to 20% down of the home's purchase price. The rest of the money is usually borrowed from a lender in the shape of a home loan that will be repaid to your lender on a month-by-month basis plus interest for as much as 30 years. Banks or mortgage providers will want to confirm that you and your family have enough monthly money rolling in to protect their investment in your new home. They'll want to make certain that you can afford that new monthly payment. Banks or mortgage lenders typically will allow up to 28% of your family's income before taxes as your month-to-month home repayment. Let's look at an example. Every 30 days, you're bringing home $6,000 before taxes. That would mean that $1,680, or 28% of the $6,000, is the most that a bank would like to see go toward a monthly housing payment. This amount, 28%, would take into account not just your new home mortgage, but all housing costs, including property taxes, whole home insurance, and mortgage insurance for those that have it, many of which will be rolled into the monthly payment amount of your new home. The next item banks and mortgage lenders will consider is your family's debt to income. What is DIR, or debt to income ratio? While up to 28% of your monthly earnings can go toward housing, this is not all the banks take into consideration. You may have various other debts such as bank cards, automobile loans, or college loans. Your debt versus your monthly revenue tells you your debt to income ratio, or DTI ratio. To find out your debt to income ratio number, tally up how much you pay monthly toward debts like vehicle repayments, bank cards, college loans, etc. Once you have that total number, divide that amount by your month-to-month earnings. So let's revisit the example of a new home buyer that is making $6,000 each month before taxes. Now pretend that that new home buyer will also have to keep paying their $500 every month toward other debts such as a car payment. Simply divide 500 by 6,000 and you'll get the new home buyer's debt to income ratio of 8%. That is a very low debt to income ratio number. Now, you'll also need to include the new monthly home loan payment of $1,500, making your total monthly obligation $2,000. Now divide $2,000 by your total monthly income of $6,000 for a debt to income ratio of 33%. The large majority of mortgage lenders would like to see debt to income ratios of 36% or less. This means that your entire debts, including your new home mortgage amount, should total no more than 36% of the household's pre-tax earnings. Having said that, in today's crazy seller's market, keeping your DTI ratio under the 36% threshold is very hard in certain parts of the United States. If you're living in one of the more expensive parts of the US, you may need to nudge this ceiling up a bit. Most financial experts suggest that you do not go past 40% debt to income ratio. I know these are a lot of numbers, so to make all of these numbers easy, I suggest you search free home affordability calculator on Google or another search engine. You can find several free online debt to income calculators that can help you determine where you are at and how much home you can afford. Remember, crunching your numbers on one of the many online home affordability calculators will only give you a ballpark figure of how much home you can afford. If you really would like to get a more precise estimate, speak with a loan provider in your local real estate market about getting a home loan pre-approval. Lenders will do this for free, hoping to earn your business when you do decide to get a home loan. The mortgage lender will scrutinize your money and then give you a pre-approval letter which agrees to loan you money to purchase a home. Since lenders won't loan you more cash than they believe you are able to easily pay off, a pre-approval is a good method to evaluate what house price you are able to pay. The pre-approval letter from a local lender also shows real estate agents you're serious and truly can afford a home in your local real estate market. You'll need this letter anytime you're putting in an offer on the purchase of a new home. With all of this said, in spite of how much a lender is offering to loan you, keep in mind that you understand your family's finances best. Understand your own personal numbers. Be sure to consider all debts, including utilities, food, cell phone bills, cable expenses, and other miscellaneous everyday expenses as well, to protect you and your family from overspending. Thanks for watching this video. Be sure to like and subscribe below. I'll see you on the next video.